Listen, if you've been anywhere near the global currency markets recently, you know we are in the middle of a truly historic week of volatility. We're talking massive structural shifts and, quite frankly, an absolute collapse of the Japanese yen that is literally rewriting the record books. So today we're going to use this explainer to break down exactly what happened, look at the fundamental news driving these wild swings, and untangle the high-stakes game of intervention playing out right behind the yen's historic plunge.
Okay, let's dive into this. We've got a lot of ground to cover. We'll start with a quick global Forex market overview, then zoom in on the yen hitting a 40-year low. After that, we'll map out the timeline of the drop, dig into the three core driving forces, and wrap up with exactly what you need to watch next.
Section 1. The Global Forex Market Overview, which is really the macro anchor for everything else.
To really grasp Japan's crisis, we've got to look at the broader macro picture first. There's a very clear divide in currency strength right now. On one side, we have our dual strong currencies, right? The US dollar and the British pound. These are anchored by rock-solid monetary policy expectations. The market fully expects rates to stay firm, which keeps these currencies flying high. But on the flip side, commodity currencies are collectively dragging. This sector faced some heavy pressure this week, completely lacking any upward momentum. The Canadian dollar in particular was the absolute worst performer of the bunch.
And caught right in the middle of these extremes is the euro. It didn't really pick a clear direction. Instead, it whipped through massive repeated swings. This crazy repetitiveness in its price action made the euro the highest-risk mainstream currency to hold this week, especially if you were on the wrong side of that volatility.
Moving on to part 2. The yen hits a 40-year low. Our hero in crisis.
Now, what's really interesting here is that with the US dollar acting as basically an immovable force, the yen became the undisputed main character of the week. Right out of the gate on Monday, it surrendered crucial ground, plummeting to an astonishing 161.96 against the dollar. Now, if you follow Forex history, that number should be setting off alarm bells in your head. We haven't seen the yen at this critical threshold since December 1986.
I mean, just think about the sheer historical weight of that for a second. That is a 40-year low. 4 decades of economic cycles, crises, and currency valuation just wiped out. Sure, the yen has been steadily weakening for months, but breaching that 162 mark, that's a massive psychological and historical milestone that absolutely shocked the global markets.
So, how did we get here? Let's get into part 3, the timeline of the drop. Essentially a chronological battle.
Tracing the week, Monday and Tuesday were really the starting point of this aggressive depreciation trend. The yen broke right through 162. And get this, even when better-than-expected Chinese economic data dropped on Tuesday, it did absolutely nothing. It completely failed to generate any meaningful rebound for the yen. By Wednesday and Thursday, the sell-off just accelerated. The dollar was hovering near a 1-year high against the euro, while the yen was stuck down in the basement at its 40-year low. Market sentiment went into total overdrive here. Traders were actually mapping out scenarios where the dollar-yen pair could hit 200. Short-selling capital aggressively piled in. It wasn't until Friday, when the U.S. non-farm payrolls data significantly missed expectations, that the dollar finally slipped from a 13-month high. This broad Asian market rally gave the yen a slight passive reprieve. Just a quick moment to breathe in, but keep in mind, it was driven entirely by U.S. data, not Japanese strength.
Early in the week, Japanese authorities tried what we call verbal intervention. Issuing stern warnings without actually opening their wallets or spending real capital to buy or sell currency. The problem? Short sellers completely ignored it. They knew rhetoric alone wasn't going to halt this fundamental depreciation. The Japanese authorities have been using these verbal warnings for months without taking physical action, so the market just decided that the actual line in the sand was constantly moving backward.
Then, on Friday, alongside that U.S. data release, Japan's finance minister stepped up to the microphone again, and he said they are ready to take appropriate measures to respond to currency fluctuations. Notice the incredibly restrained phrasing there? There's no furious threat, it's very measured. But it creates this sort of Damocles effect hanging over the market. Because the wording is so controlled and just touches on the issue, it creates a deep psychological fear among traders of a sudden, unannounced surprise intervention. And honestly, this fear of a sneak attack from the authorities actually capped the yen's Friday rebound and kept the entire market incredibly tense.
All right, part 4. The 3 core driving forces. Let's lift the hood and see what's actually powering this.
So, the crucial point is, why did the yen fall off a cliff? It wasn't random. It was a 3-part collision. policy divergence, fundamental weakness, and intervention speculation. Let's break down how these three elements collided.
Driver number one is the massive policy divergence. The U.S. Federal Reserve remains hawkish with high rate expectations, while the Bank of Japan is just clinging to its dovish, continued easing policy. This massive, ever-widening interest rate gap is continuously pulling capital right out of the yen and pushing it toward the dollar. It is the fundamental, inescapable gravity pulling the yen down.
Driver number two is the short-term catalyst. It's not just about interest rates, right? There are deepening market fears regarding Japan's underlying fiscal outlook. The fundamentals just aren't providing support. When you combine this lack of fundamental economic backing with the interest rate gap we just talked about, it's like throwing gasoline on a fire for short sellers. They see the fundamental weakness, they aggressively add to their short positions, and that drastically accelerates the short-term depreciation pressure we saw on Wednesday and Thursday. And driver number three, like we mentioned, is the intervention speculation. It acts as a weird volatility regulator where traders are constantly trying to guess the exact moment the Bank of Japan will strike, causing massive, unpredictable ripples.
Finally, Part 5. What to watch next? The horizon.
Let's move ahead and see how this builds, because next week the market is laser-focused on two major catalysts. First up, U.S. inflation data. The impact here is pretty clear-cut. If U.S. inflation comes in hot, it's going to boost expectations that the Fed will keep rates high. That widens the interest rate gap even further and potentially opens up way more room for the yen to drop. But on the flip side, we have the BOJ psychological threshold. If the yen continues to slide, does it hit some hidden line in the sand that triggers actual physical market intervention from Japanese authorities? Because if they step in and buy yen with real capital, it could instantly shatter the current short-selling consensus and cause a massive, violent correction upward.
So right now, the global market is locked in a massive, high-stakes game of chicken with Japanese authorities. Verbal warnings? Failed. The 40-year floor? Fallen right through. The fundamental divergence is literally wider than ever. So as we head into next week's volatile trading sessions, the ultimate question hovering over every single Forex desk in the world is simply this: will the Bank of Japan finally strike? Thanks for joining me for this explainer. Keep your eyes on the charts, and we'll see you next time to break down whatever the market throws at us.